All right. Good morning, Checkmate crew. It is the opening bell of the New York Stock Exchange at 9:30 a.m. on this Tuesday, November 1st, 2022. Yours truly, Mickey Blindside here with your market memo. Okay, so we are, it is the day before FOMC. All right. We will see what happens tomorrow. Today, however, I wanted to go over some of the earnings that came out. We've got some plays that we've already started legging into. One of them is PPC, Pilgrim's Pride, which is the shame of my portfolio right now. But we do have a food thesis. We have a thesis that food prices are going to keep going up into next year. We also have a uranium thesis as well. So I wanted to add and re-examine our thesis based on some of the key earnings that came out. Let's start with food. Okay, so last week we had PPC come out with earnings. So PPC came out with stellar earnings, much bigger than expected. They overperformed on the profit side. So that is partially, if you look at the volumes, okay, so if you look at their earnings and the actual amount of chicken volume that they did, it wasn't that big of a difference, okay? Year over year, quarter over quarter, it just wasn't that big of a difference. Where the huge beat came from is pricing power. Okay, the management they said a key phrase there. They said whenever prices of protein goes up, chicken is one of the least sensitive to those inflationary pressures. Okay, and so they are able to raise prices of chicken to the point where that made up all the gains in their profits. Okay, and so that is a good sign, okay, especially for us that are in PPC. That is a good sign. And just as a backing to this, McDonald's also reported stellar earnings last week as well. And a lot of that actually has to do with chicken. They actually came out with the adult Happy Meal. And they're pushing their chicken nuggets. And not only that, in Europe, they had stronger than expected sales in Europe. A lot of analysts on Wall Street are saying, oh, it's because of the weather. It's because of all the reopening that Europe did after COVID. All of these stories. But really, in the end, I think what it is pricing power. Basically, they're able to raise prices on their chicken nuggets, their crispy chicken sandwiches, and that's also another thing that the management, they mentioned in the earnings call. They had strong growth in their chicken burgers. They even have a chicken Big Mac in Italy. It did extremely well. And so right now it looks like our chicken thesis, whenever beef prices go up, people start getting and eating chicken. And chicken, because it's such a cheap protein, they're able to raise the price and really raise the margins on chicken products. And we're seeing that. So our thesis, I think, it holds true. And I do think, even though we're kind of down on PPC, I still think, though, in the next 3 to 5 years, we'll probably profit from this, okay? And I do think that based on earnings growth, we might see finally PPC break out of this range, okay, and break out that 40 range. I am in it from 28. I did do an initial buy, and perhaps if it gets back down here into the 20s, I might buy again. All right, so if it retests this or back tests this breakout, if it maybe comes down to, let's say, around even 22, I may even buy some more and leg into some more shares of PPC. Okay, so the earnings for PPC, McDonald's, it's all working out. Our plan is basically working out. Our thesis is becoming more and more true. Okay, last week we also had CCJ, Cameco. I think that's how you pronounce their company name. But this is the largest uranium producer in North America by volume. And so they also came out with some earnings. They actually came out with worse than expected earnings. They actually had when you look at their standardized accounting practices, it actually was a loss, and a lot of that loss came from their derivatives hedging. Okay, so Cameco also, CCJ, not only do they produce uranium like out of the ground, like out of a uranium mine, but they also buy in the spot. They put it in storage and they try to sell it when it's at a greater price. So they do, do a lot of derivatives hedging as part of their regular business activity, and that caused a negative. I'm not sure if that's just a one-off this quarter, so the CCJ earnings wasn't as clear. One thing, though, the one big takeaway from CCJ was that it doesn't seem as if there's going to be a lot of long-term deals that get finalized at the end of this year like was expected. Most likely, according to CCJ management, a lot of the deals are going to get finalized early next year. This year right now they've agreed upon pricing mechanisms, and certain terms, but the deals won't finalize until 2023. So maybe that's why we saw a little bit of a sell-off. We did have an outside day down in CCJ. It looks like we are gapping up, but this might be some resistance. There could be a lot of supply here. People who got in after the earnings thinking that, this is going to go up, but then it just went down and went below the lows of the day prior. So you might see a lot of supply right here come into the market. A lot of people who went long here thinking that it's going to break out, but then they got trapped. All right, so we might see this, get revisited a couple times until that supply goes away, and then we could see it go higher. So we'll see. Right now, we are in UUUU. That is our uranium play. We're not in CCJ, although CCJ is not a bad alternative. CCJ just has some debt. And they're still working through trying to pay off that debt. UUUU does not have debt. And in this rising interest rate environment, I do not want to be in a company that is burdened by excess debt. All right. And so that is why we chose UUUU. No debt. They paid it off back in 2021, I believe, or 2020, something like that. They paid it all off. So definitely, that's a huge plus for being in UUUU. Okay. So at least in our thesis portion, I think, everything is working out pretty good. Our food thesis, I think, is still intact. Our uranium thesis, still intact. Let's see what happens in the coming quarters, okay? UUUU, I think, is not going to have an earnings call until, I think it's estimated sometime next week, okay? It's either this week or next week. I didn't see any official announcements yet on when that could be, but I will definitely be looking at the earnings for UUUU, and whenever that comes out, I will report to you guys. I also took a lotto on Uber. Well, not really Uber. I did a Sympathy on LYFT, but I bought some puts. I only bought 2 contracts, So I think I lost $150 on this. It is what it is. It's, rather than, I guess, that $1 billion Powerball, I guess I spent it on this. But anyway, Uber actually missed on their earnings, but they're gapping up. Okay, so what does this really mean? Okay, what this really means is there's no more sellers anymore. There's no more sellers. Okay, everybody was positioned and maybe perhaps hedged, and now there's just no more sellers. I think this is the beginnings of a sign that perhaps we may be bottoming in the market, at least for this year. Okay, I don't think you guys know what I think about emerging market crisis and solvency risk. I think that comes up again. I think inflation will come back in 2023. End of 2023, maybe even beginning of 2024. That is probably when we're going to see a lot more volatility in the market. But in the short term, this may be the bottom. This may be the bottom for maybe this season or for this year. Okay. And I think Uber kind of shows that, how can you miss this bad and still be up like this? It must mean there's no more sellers. Okay. There's no more sellers. So we'll see. Okay, but anyway, I just wanted to share that. I think that's a pretty good tell that there's a very good chance that this may be the bottom for the year. Okay, I do think though that this bear market is not over. This multi-year bear market, I don't think is over. I think it'll last a couple of years, but within this big bear trend, we may see mini bull markets in between. Just like the 70s. I always allude to the 70s for this market, but just like in the 70s, we had like a couple of years, like a mini bull market in between two larger sell-offs that really was part of this one big bear market. We also saw that in the 90s. We saw a temporary, like a couple of quarters where we had positive market performance, and then we went back down to continue the bear market. So, we could have a little bit of a mini bull market and then back to bear market maybe, 6 months to a year later. So I'm just going to keep an open mind about it. But again, I'm starting to see signs that there's no more sellers. But we'll see. Okay. Tomorrow is FOMC. We have, pretty much a 75 basis point rate hike that's baked into the bond market right now. Let's actually take a look at that together. We'll actually take a look at the FOMC countdown. So right now with the FOMC countdown, we got a 90% chance we're going to see a 75 basis point rate hike in tomorrow. In December, it looks like right now the greater chance is for a 50 basis point rate hike. And then for February, we've got another potential 50 basis point rate hike. And it looks like we're topping out on the Fed funds rate at about 5%. It looks like still. Yep, it still looks like we're topping out at about 5%. All right, and for a possibility then around November, December to see a rate cut, okay, at the end of 2023. So that's what right now the Fed funds futures market is pricing in at the moment. Again, we'll see. All right. Remember back in May, June, we were talking about Bill Dudley. Bill Dudley was saying 5% then. And I said, hey, if Bill Dudley is saying 5%, most likely Jerome Powell is thinking already 5%. And lo and behold, look at this. The bond market now is pricing in 5%. So I guess Bill Dudley was right per usual. Okay. Today also marks the first day of the month. So I wanted to go over some monthly charts with you guys. First things first, let's look at the dollar. The dollar has really been the key, guys. Whenever the dollar has been rallying, we've seen a risk-off sentiment in the market. And whenever the dollar has been receding and coming back down and cooling off, we saw a risk-on sentiment. And this is the monthly chart on the US dollar index. I'm still looking to get long on the dollar on some major pullbacks. 97 would be nice, but I may even attempt a long, maybe even higher up around 104 and 105 zone. Okay, and I will use UUP. I will be using in-the-money calls when we get to that point. But I may be legging in maybe a small position at 103 and 97. It really just depends. I would really like to see a bottoming signal at 104 before really getting into that zone. If I don't see it, then I'm probably going to wait for a lower level, probably around 97 or so. And it could pull back there and then come back up again. Okay, it doesn't have to go up in a straight line. though I do believe that dollar is going to keep going up. And we've already talked about this thesis as well too for our emerging market solvency risk. With large bond payments, most international debt and bond servicing is denominated in dollars. Okay, and so there is a lot of emerging market debt payments that are going to come due at the end of 2023, beginning of 2024, mid to end 2023 mostly. But that is where we'll probably see the dollar going back up again, and we'll probably see also a lot of emerging market central banks have certain credit and solvency issues. And I think that with higher inflation, all of it at the same time, could really send markets into a volatile season. Again, I think end of 2023, beginning of 2024, that's probably when we're going to revisit some of these levels after probably a period of some, a period of a bull market that could last, a couple of months. So again, it just really depends. All right. We're looking at liquidity data. So depending on what happens to our liquidity data, that outlook may change too, but for now that's what I'm expecting, and that's what I think will happen. I could be wrong, but I'm just trying to anticipate what could happen in the future. All right, so right now our dollar chart, that's where we're getting a lot of our levels to get back into the dollar. I am looking at around that 103, 104 zone, as well as the 97 zone to get long on the US dollar via UUP in the money calls that are dated, about 400 days out, about a little bit more than a year out. I'll be using those to get long on the dollar. Okay. I also want to take a look at some of our rate spreads monthly charts. So right now, this is the 5 and 2. Right now, this is definitely showing us that it's still profitable to have cash. All right. The 5-year yield is it is quite elevated. So is the 2-year. So again, why even risk for a portfolio manager? 4.4% on a 2-year treasury is pretty attractive. That's like half the quota for a fund manager, and they could just park their money into a 2-year treasury and not get fired if the market sells off. So for fund managers, their number one priority is to not get fired. So again, right now rates are elevated. They're much higher than where we were back in 2018. And I think that has a lot to do with the risk on and risk off sentiment in this market. 30 and 10, this is what a lot of professionals like to use to gauge the health of the economy. We are in a low point right now in the 10 and 2. We were inverted, more inverted than since the late 90s and early 2000s, and we have just come off of those levels and into finally some positive territory. Also too, if you look at our copper to gold ratio, our copper to gold ratio times 1,000 is a good indicator for where the 10-year treasury rate will go. Okay, generally, and then since 2007, it tends to be they track very well. Now, there are discrepancies at times, and when there are discrepancies, usually it's the 10-year yield that comes to play catch up with that copper to gold ratio. Okay, so again, usually the copper to gold ratio will move first, and then the 10-year will follow in both directions. So again, right now our copper to gold ratio is down. I do think our 10-year rate will come down, bringing 10-year bond prices up, yields coming down. I do have some TLT calls. I did get into them way too early, and I tried to be way too clever with that. I was using them as a hedge for my hedge on UUU and the collar trade that I had. And in hindsight, that was probably one of the worst hedges of a hedge that I could have done. I could have just bought some call spreads on SPY, and that probably would have done better. But anyway, I still have them. They expire in a couple of weeks. They'll probably most likely expire worthless. It is what it is. they were so small, and again, they were hedges of a hedge, so I positioned them accordingly. But I do still think that there is a chance. Maybe after FOMC, maybe there might be a reaction. We do have a record short position in Treasury bond futures, so if they get all unwound at the same time, we might see it come down. I don't know if it's going to make one solid move like this, but it could, maybe over the course of like a week and a half. Also, too, with the midterm election coming up, if there is a split Congress and a split government, that usually means that a lot of big spending bills do not pass, and that could also put some pressure down on the 10-year Treasury yield. And if that's the case, we might see a couple of weeks where this really comes down and TLT and bond prices go up. I'm not banking on it. It is what it is. Those TLT calls, I'm either going to be a hero or they're going to go to zero. Most likely go to zero because they probably don't have much time. But I do think that at some point this does come down, and when it does, we'll probably see a wave of risk-on sentiment in the market. Again, I think that's going to be very temporary. It's going to be short-term, and short-term meaning it could be like 6 months to a year. I think 6 months to a year is very, very short-term, but it may be some type of a mini bull market like that. And this might be the impetus for that, this coming down, the yield coming down. All right. So that's the monthly chart that's the stuff that I wanted to look at least on a monthly chart. Oh, one more, TIP-TLT, our forward inflation indicator. Our TIP-TLT is coming down. Remember I said that, there's a chance that this might be a false breakout. And that might be the case. If this for this month, if this comes down, this month and gets back into this area, it does become a false breakout on the monthly chart. On the weekly chart, it did already start the false breakout formation, and if in another week or two it can get in that box on the weekly chart, that would also signify a false breakout on the weekly chart. And then on the daily, on the daily chart, you know what this looks like? Looks like a lower high. And do we make a lower low? All right. If we can make a lower high and a lower low, and that can last maybe a week or so, I think that would put some tailwind on the NASDAQ. And we may see our growth to value chart reverse. Okay, so if we start seeing lower highs and lower lows on the TIP-TLT daily chart, all right, we might see our growth to value chart making higher highs and higher lows. So we might see then QQQ and growth outperform value. Very possible, okay? But I don't think that happens until TIP-TLT comes down and makes that downtrend. Again, lower highs, lower lows. If it does that, then this might reverse, okay? Oh, speaking of which, let's look at more current stuff. So that's the monthly stuff that I wanted to look at. It looks like highs minus lows. Looks like highs minus lows is firmly positive today. We haven't seen a positive day like this. If it can hold this, we haven't seen one since mid-September. That would help curve this line up. This is our high-low cumulative line. It's already starting to flatten, but if it starts churning up, we could see if it flattens and turns up, and it gets higher than one or two of these moving averages, we could see a bear market rally that lasts a few weeks. All right, it really doesn't get into a much longer bull market, even if a mini bull market that lasts like a couple months to a year. We usually need to see this turn up above all three of these moving averages for that. Okay, again, that signal has not been given. All right. Oh, why did everything go off? Okay, New York advanced decline line, it is going up, so market breadth is increasing. All right, and then our equal weighted S&P 500 is also going up as well too. So there's a lot more participation in this market in the rallies. Okay, usually those are positive liquidity signs. Also, our new our junk bonds ADL, it did make a negative yesterday, but it was a small negative. We had 1, 2, 3, 4, 5, 6 days in a row of advances. Okay, usually when we see 4 days in a row of advances or more, usually that bear market rally can last a few weeks. The last time we had something like this was back in July, remember? Remember back in July? Back in July, we had this rally. It lasted like 3 or 4 weeks, okay? That was also right as earnings season started too. So we're seeing some parallels to that right now as well too. Again, my plan really hasn't changed. I'm going to short at 41.25 via put vertical debits. And depending on what our growth versus value ratio chart is doing, if it's still in a downtrend, I'll go with QQQ puts. If it's starting to change its trend, if the growth to value chart is actually good, is starting to change its trend, I may just end up using SPY vertical puts 3 to 6 months out. So it really just depends on what our liquidity data and what our ratio charts say at the time. But I am going to short US indices when we get to that 41.25 zone. That is my trigger. And that's just where we saw a lot of options hedging happening for the year. Also, that's where we really start getting bearish on the options positioning for OpX as well, for options expiration. Right now, delta neutral is around that 3,900 to 4,000 zone. So we're right there. We're just, actually, we were starting to get delta neutral, and look at that. It just backed off from that delta neutral range. All right, so we're backing off from our delta neutral ranges already. So 3,900 to 4,000 is our delta neutral range. Already we're pulling back a little bit. I wouldn't be surprised if we pull back just a little bit. Maybe we just rotate around there for the rest of the day and just really just stay under there until the FOMC or until the CPI report next week. All right. And maybe that's when we might see it get to 41.25, or it could even be next week the midterm election. Usually after a midterm election, we also see the volatility and the VIX compress, and if that happens, we might see dealers needing to delta hedge all their puts going down in value. They may have to cover and buy some of the underlying, so that might take us up to 41.25. Whatever the reason it may be, right there, that's where the reward to risk really gets in my favor for puts. And again, I'm going to be buying some put vertical spreads for 3 to 6 months out. Speaking of put vertical debit spreads, another Euro. Let's see here. Euro Stoxx. DAX is getting much closer to our short level. Our short level here is on 13,800 on the DAX, on the German stock exchange. If it gets to 13,800, I think there's a very compelling area to buy some put vertical spreads on FEZ. FEZ, okay? FEZ, I might be buying the January or the February expiration. Actually, the February expiration doesn't even look that bad right now. Actually, let's take a look at it right now. FEZ, Febs, that's 108 days. If you look at the, let's look at the 3530. I think that's the one I was looking at. Obviously, we're not doing this now. Obviously, that's, the DAX getting to 13,800 is still about 3% away. So what, 3% of this, about another $1 or so. So that'd be around like 35.90. All right, so another $1 away, but already it's at, between 135, 170. Let's say we can get a fill around 150 or so. So probably this will be around 120 by the time that this gets to, this makes a 3% more rise. Okay, so if FEZ and DAX go up another 3%, we might see this 35.30 put spread on February get to about 1.2-ish, 1.2-ish. So that would give us, 3-to-1 reward to risk ratio. That sounds pretty good to me. All right. So I'm looking for that. Again, I'll make that assessment as we get closer and closer to that. The IV may shift a little bit, so we might not get exactly that fill. So if the Januaries look better, I'll go with January. But if I can give myself a little bit more time, I wouldn't mind doing so. Even though gamma doesn't work as much for me, I'm more concerned about preserving my capital and making sure my losses are small. So I don't mind missing out on a little bit of gamma and getting a little bit more longevity. Okay. All right. So that's that. Anything you guys want to look at? Oh, crypto. You know what? I almost forgot. Crypto. Crypto. Very interesting going on in crypto markets. We're starting. You remember last week, guys? We started seeing the open interest really increase on these Ethereum options. We're now at 7.2 billion in notional value. It was backing off a little bit. Now it's coming back. We are now in a high gamma, very positive gamma zone as far as dealer positioning is concerned. It's right at that 1600. This 1600 seems to be where there's a lot of long options, not just in the the ones that end this week for November 4th, but it seems like as if for every expiration this month, going all the way to November 25th, it seems as if there's a lot of positive gamma right here at this 1600 strike. All right, so what does that mean? We could see a gamma pin at 1600 for the rest of this month if this keeps, if the order flow doesn't knock it off of this gamma pin. Okay, we could see that. So as long as notional value stays around 7.2 billion and as long as the order flow remains around the same as it is now, we may see Ethereum just kind of bounce around 1600, go up and down past 1600 until after Thanksgiving. All right, that would be interesting. Okay, and that's what the gamma positioning is telling us. And not only is the gamma positioning telling us this, but if you look at some of the big orders, there was one really, really large order that I wanted to share with you guys that kind of supports this, or it coincides with this too. Yes, just not too long ago, somebody sold a straddle 1600 puts and 1600 calls for November 25th and collected, okay, around $1.2 million of premium on this. All right, around that 1600 strike. Okay. Maybe this is where all the positive gamma positioning is coming from. Actually, this trade, it could be this trade, who knows? But there seems to be speculators out there that think, hey, until the end of the month, there's not going to be that big of a change in Ethereum value around this 1600 strike. Okay, so there's some big trades that are saying that. Okay, so right now, over the weekend, while I was asleep, I did end up taking a third of the profits of our Ethereum position at 1650. We did take a third profit. The rest of the third is going to be taken at around the 1900 to 2000 zone. I believe it was like 1980 or something like that where my limit order is. So I have all my limit orders set. And then, with the amount that I took profit at 1650, I will be using those funds to re-enter into ETH at this green line with that 1/3 position that I sold. So whatever I sold at 1650, I'm going to use those funds to buy at this line. Of course, still, my main buying level, my big buy zone, is still when ETH gold ratio gets to this zone right here to our red trend line. Okay? That still hasn't changed. All right? Anything else you guys want to look at before I go? Going once. Oh, you guys want to look at AMD? One of our members requested AMD. What do you want to look at for AMD? AMD. Is it earnings today? earnings after market today. So yeah, there's earnings after the bell today. I mean, if you want to gamble on that, be my guest. I will not be gambling on that. I'm sure the IV is all jacked up per usual. Of course, yeah. Look, no way I'm buying any of those. I mean, guys, you don't have to directly gamble on the options chain of whatever it is having a binary event like earnings. If you want to gamble on AMD earnings, you can always also buy options on another semiconductor, or you even use SMH, use an ETF even that has lower IV values. You may not get that 1-to-1 mapping. You may not get that 1-to-1 correlation though. Okay. And you may not get the full movement, but at least you don't get all that, you don't get as large of an IV crush though. Just a suggestion, sometimes it works like that. Sometimes it doesn't. Okay. Sometimes doing something like a sympathy play can work. And sometimes it doesn't. So that also has its other layer of risk as well too. But that IV crush really just puts the odds against you. All right. So I don't know if you guys are gambling on that, but there it is. If you actually look at some of the other chip stocks like NXPI, they just had earnings recently. They actually did well and surprised on the upside. They did beat their numbers. I believe Texas Instruments, is it TX? Texas Instruments, yeah. I think Texas Instruments also beat on earnings as well too. Okay. So, and I mean, it dropped, but then, now it's back to where it was before. So I would say that is not a negative reaction. I mean, it's for one day. I know, of course, the media is going to be like, oh, yeah, it dropped after the earnings. Yeah, but, 4 or 5 days later, we're back to where it was before. So is that really a bad reaction then? I don't think so. I think it has more to do with how the market was positioned going into the earnings than the actual earnings itself. Anyway, anything else you guys want to look at? Any other tickers? All right, well, in that case, that wraps up our session of the Morning Market Memo. Our Discord invitation link is in the description. Come join our Discord. Be a part of our growing community. There's no sub fees, no paywalls. It's of the people, by the people, for the people. If you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. I'll be back here tomorrow, 9:30 a.m. Eastern Time at the New York Stock Exchange opening bell. I'll see you guys then. Trade safe.